Hello guys and welcome back to Tech Trick Tutorial. In today's video, we will talk about what is Bitcoin and how does it work. Now, Bitcoin is a very popular cryptocurrency. We will talk about what it is, we're going to define it, and we will be explaining the history and how the Bitcoin works alongside with how other cryptocurrency works. Bitcoin and other cryptocurrency work very similarly with one another, where they work under the blockchain, which we will then explain also later on. You could also visit bitcoin.org, which also has their own explanation on how the Bitcoin works and how it is passing through the network or through the market. So, I have here a small Canva presentation where I discuss the most basic information about Bitcoin. So let's start with a very basic description over here. Bitcoin is the first decentralized cryptocurrency. It is invented in 2008 by Satoshi Nakamoto, which is an unknown person. This person developed a cryptocurrency where people can make transactions without going through banks or without having the cash in actual physical manifestation. People can make transactions without going through the government and through banks, meaning their transactions would have less bills or less transaction fees. Now, Bitcoin can be utilized all around the world. You could use it to purchase anything you want and in any country. Bitcoin has a very big value as of now. As you can see here, one Bitcoin currently costs $96,000 and more. You could see the history of Bitcoin's prices over here in CoinGecko, where we could view ever since from the start. As you can see here, it only started with as low as $91. But as of now, the maximum it reached before was $100,000 or $104,000 back in December 16, 2024, which is a very high price. Now, I made a very simple discussion over here. So let's talk about Bitcoin. Bitcoin, like mentioned over here in their page, is a peer-to-peer technology where people can make transactions with one another, people can transact, and Bitcoin is something rewarded to miners who solved transactions. You could think of the transactions or the connection between transactions as a receipt. The receipt is a very long and complicated bitcode, and miners, like Bitcoin miners over here, basically solves a very complicated math to be able to figure out the key or the hash map of a specific block, and it confirms through the blockchain. So we have connections over here, and basically everyone has a copy of the transactions. Everyone has something called a ledger. A ledger contains transactions of what people transaction with. For example, this person over here sent money to this person over here on the right side. Now, this transaction needs to be kept in a ledger, of course, so people can take note or have a record of who paid who. Now, a ledger is something all of these people have. And of course, when she pays this guy, the ledger should be updated. And since everyone has their own ledger, it needs to be updated on all four of them. Now, how do they do that? We will have a miner or someone who's going to listen to the transactions, which will then send out that new updated ledger to the other person. Now, before we talk about that, let's talk about the transaction ID. There's a such thing as IDs when you're doing a transaction between person to person. There's so much things happening when Bitcoin is being passed around. But we can see over here that there is such thing as bits over here, and each transaction contains bits actually. And over here, typically there would be up to 256 bits. And it sounds small, but actually it's a very big number. It's basically consists of ones and zeros, and each transaction would have signature. People would have a PK or SK over here, a public key and a signature key. And in the signature, they would have the message, of course, and their signature key, which will then equal to a signature. And people would verify that by the same function over here, where we have the message, signature, and the personal key. And it will be determined if that's true or false. So this is where the transactions are typically verified. And with the 256-bit over here, this is the number, or this is the value, as you can see here, that there are over this many combinations possible. So guessing or having that value for each transaction or each block is a very big combination. And people or technology or machines that are actually mining right now doesn't really follow any mathematical method to verify transactions. What they do is they at most guess this value because that is the most probable and the most efficient way for someone to be able to actually complete a transaction, due to the fact that this is a very big number that all of these machines are guessing. So the way miners earn money through cryptocurrency or Bitcoin is by solving a transaction or verifying a transaction between one person to another. The receipt that you will see where the transaction of this person is being recorded, there will be a very complicated hash map or ID or bits for that specific transaction. And miners basically mines or solves that specific problem to ensure that that is correct. And the most complicated or the most work put into a solution is accepted in the blockchain. So what is that blockchain? So let me explain that over here. So we have blocks, and for a specific transaction, there are three parts. You have the transaction itself. So let's say this person over here, let's name it Jen, and this is Chris. Jen sent $100 to Chris. That would be recorded under our transactions over here. There will be a transaction list. So whether it's Jen sending to Chris sending to Jen, it will be recorded under transaction. And there would be a proof of work over here. The proof of work is basically a number over here, wherein there will be a specific combination of bits or ones of zeros over here with a specific number of zero over here. The number of zero is typically specified daily or every 10 minutes because every 10 minutes, that is the cycle of transaction. And there's a limit of 2,400 limits of transactions per day, or rather per cycle. And the number is random depending on the amount of miners. So the way it works is that miners are basically verifying the hash, which is this one over here, and the hash code. For example, we have this value over here. The hash code for this to be able to get this amount of zeros is going to be a very impossible amount of time. Like, there's a lot of work that gets into building this amount of zeros. So sometimes there would be a specific number, let's say 72 zeros must be present. So there will be a very long hash key over here that machines are actually solving, and it's going to be very difficult or takes a long time. So it's basically a lottery. That's why there's so many miners out there, and it mines for a very long time but only gets small yield of money. It's because of very difficult guess, like just like this one over here. Although this one is just very short, it's just very 21 zeros, but in real life they would be required 72 or more numbers of zeros. So we have here, which is a block. And like I mentioned, we have the transaction where you list down all the transaction and a proof of work. The proof of work is basically this one that verifies or converts our key into a bit like this one, like a transaction ID, which is going to be transferred to the next block. So this is a single block over here, and it's going to typically have a chain. So that's what you call a blockchain because it's connected to one another. the previous hash over here or a part of the block will get that combination or will get a value from the hash map of a previous block. So if one of this block are changed or are alternated, the value would change. So if this block over here specifically is put into this one and we alternated this, the values of the numbers over here would very much change, and that's going to be very difficult, or it will become invalid since it's no longer going to be the same value. It's a bit confusing because there's a lot of technical terms or math that revolves around how it works, and I'm not sure if I'm also able to discuss it in a way that people actually understand. But the proof of work or the proof of work over here is the solution a miner will produce over here. And actually, the prioritized miner or the prioritized block that is given by a miner is the one that had the most work. So let's say my miner provided a block or like a solution over here with only 20 zeros over here. And of course, someone else or another miner provided a solution with 25 zeros. It means that their work is significantly more complicated than mine, because having this specific solution will take a very long time over here. So let's say the value of 1 is significantly different. The hash map is significantly different. It's not going to be zeros over here. So the value that actually allows us to only have the 20 zeros over here is actually going to be very long, and the machine checks it one by one. So it does 1, 2, 3, 4, 5, and so on and so forth. And to be able to reach a value with a specific zeros over here, it's going to take a long time. So if you compare a block provided by a specific miner, which is going to be 20, if you compare it to 25 is going to be a priority, since that miner actually produced a more complicated work, or rather a work that has more computation, and it's more trusted that way. And that computation gets passed through from the previous hash over here and does a blockchain, allowing people to have a trusted link over here. Sometimes people could try to create a fake block, but through the fake block, there's going to be a branch that has or needs to have a continuous supporting block from that fake hash. So let's say this is a fake hash. They inserted it. So let's say I made a fake transaction where you paid me $1,000, and I have a block over here where I have a proof of work, transaction, and so on and so forth. Now, it needs to have a succeeding previous hash over here that's consistent with the general ledger. We have the general ledger like I talked about earlier, which is going to be, it needs to be exactly the same for everyone. So the persons over here should have the exact container or exact copy of the ledger. And if someone faked a block over here and their ledger did not get updated or did not receive the same block, it would be deemed that this is fake. So it's like a puzzle over here where there will be a specific unique key or unique puzzle piece into the blockchain where people can't really fake a specific block because it requires to have, or it's going to need to fit into the big puzzle. People can't force a specific piece into the puzzle by having a fake block because it's going to be continuous. If this is present, the values, like I mentioned, came from the previous block. So it needs to be consistent where the solution will make sense. If someone has this fake block and then the real block has different output or different hash over here, you will be able to easily identify that this is a fake block over here. So that's how the blockchaining works, where people or like miners listen to transactions. So let's say Chris and Jen makes a transaction, $100. The block or the miner will listen to it. It will create a block, which is this one, a list of transaction, then creating a proof of work, and then broadcasting that block or broadcasting it to the ledger, meaning on this person's ledger, they will be able to receive the information that Jen paid Chris $100. So now everyone knows that a transaction happens and that's kept on a ledger. So everyone knows that that occurred. And this person, the miner or your machine, will get a reward for verifying that. The fastest to create a block with the most zeros or the most work will get the reward. And the reward for each miner varies. For mining, there's something that's occurring right now wherein every 4 years, the reward gets half or get cuts in half. So back in January 2009, people would receive 50 Bitcoin, or block miners or miners would receive 50 Bitcoin per transaction. And every 4 years, it gets cut in half, and through mathematical computation, we now know that Bitcoin will never be more than 21 million. Because of that value, because of that limited stock, the value or the available Bitcoin in the market is going to be very limited. But how do miners then get Bitcoin if the value gets lower and lower? Bitcoin miners get money through additional incentives. So people who are doing transactions would include a little incentive, like let's say for Chris and Jen to have a transaction be listed under a block, they would give the miner like 5 or 0.005 Bitcoin so that they would be included into a block. Now, why do people do this? Why do they want their transaction be included into a block? That's because there is a limit to a block. Like I mentioned earlier, there's a limit to 2,400 limit transaction per day. And there's so much people out there utilizing the blockchain or utilizing cryptocurrency to make transactions. And so that they could be prioritized in a transaction, they would add an incentive which includes Bitcoin to be paid to the miner, and through that, the miners can still earn a fair amount of Bitcoin despite the restriction over here where Bitcoin gets lower and lower. And of course, because of that, there will be higher transaction fee through that. But it still does not beat the benefit of having a Bitcoin or utilizing Bitcoin where we are able to get through or pass through government without, or in comparison to the government or like the banks, it's still going to be a lower amount. Now, there are many ways for you to be able to earn Bitcoin. There's trading, of course, just buy and sell, but the main one is mining. And in Amazon, there's so many products out there. It's both cheap and expensive. Of course, the cheap one would be slower, and the more expensive one would have more computing power to solve for, or to solve for the hash map available in a bit ID or like a bit code over here. Like I mentioned, the value is super big, so it's going to require a very powerful machine to be able to have or be able to mine Bitcoin. And so there's all kinds of products over here that allows you to mine, and we could even computate here how much we would actually be earning. So let's say this one over here, this very expensive miner, we have a micro BT, which costs $14,000. We will be able to earn $13 per day. It's not that big because it's a very difficult computation and there's not much coin or Bitcoin that you are able to mine, as you can see here. And there's electricity cost, of course, and there's so much information that is going to be available over here. So let's go for a relatively cheaper among the list over here. So let's go with one that costs, let's say this one, $3,000. So the $3,000 would give us $4 worth of Bitcoin profit per day. So it's not really that big, but people would not have just one of this Bitcoin miner. People like in the YouTube, you could view here, people would have racks, warehouses filled with Bitcoin miners. As you can see here, these are examples over here, and people could mine a lot of Bitcoin. And of course, the electricity would cost a lot, but they could actually negate it with the Bitcoin or the amount of money that they are actually gaining. Like we can see here, the calculation. You would earn more dollars in comparison to the electricity cost, as you can see. Let's check out this one. This one is more expensive. It's actually very similar, as you can see, 4.20, despite it being more expensive than the first one we tested over here, as you can see. But you will be able to see the profit margin in this page as well in the coin warts. So if you're interested in mining, you could invest in one of these machines over here. You could look through different machines available in Amazon, and you can even watch people in YouTube, how their rig works, how their miners work, and so on and so forth. So you have a better understanding on how cryptocurrency mining works. We could see here, as you can see, we could go back here in the last 24 hours. The pricing of Bitcoin has been going up and down. So it went down to 94,000 over here at what time this is this? Like 3 p.m. And then it went back up again and so on and so forth, as you can see. You could see that it's a very competitive market. Like there's so much action happening. There's so much ups and downs. We could see here how much it has grown ever since. So Bitcoin and cryptocurrencies around the world, or like all the different cryptocurrencies over here, work in a very similar way where they just function as a transaction fee or a reward for miners who are actually able to solve a transaction. People use cryptocurrency and Bitcoin to move around money. And of course, Bitcoin itself has its own value, and like very big value, of course. But people utilizes this cryptocurrency to move around very big money around the market, and they use this cryptocurrency as a payment for allowing them to proceed with the transaction. There's so much politics, there's so much hidden things that you are able to learn in Bitcoin, but I would recommend that you have your own research aside from this video. You watch other resources out there that would be more in depth with the topic, have more topics discussed, and explain better, of course, with better visualization, at least with how the block or the blockchain works, since a Bitcoin is part of the blockchain and other cryptocurrencies is part of the blockchain. The different cryptocurrencies over here work the same way as I explained over here, where each blockchain is monitored by everyone. So it's very difficult for you to fake a specific block, although it's possible, but it's going to be very difficult because of the computation time. And there's so many other miners out there, so it's very or near impossible to fake a blockchain or like an entire block, because people will monitor this before they trust it, because of course. So people don't really usually just trust one block. People would wait an entire block over here, like they would wait for 8 blocks before they trust that that is a legit block, and so on and so forth, if all the math works out, as you can see. Now you could learn about how other cryptocurrencies work. They work very similarly with how Bitcoin, since Bitcoin I think is the first one or was the inspiration for majority of the other cryptocurrencies over here. So they're all in the blockchain, so they will all work in a very similar manner. Although their pricing over here will vary differently, as you can see. The first one is Bitcoin, and the pricing is 96 or 97,000. And the next one is Ethereum over here, as you can see. The pricing is vastly different. So Bitcoin is very expensive, aside from the fact that there's always a limited amount of Bitcoin in the market with this formula where every 4 years the reward gets cut in half, and there will never be more than 21 million Bitcoin in the market. So how much Bitcoin is in the market right now? So currently there is 19 million. So the max supply is 21 million, as you can see. So there's only almost 2 billion Bitcoin available in the market for people to mine. But people could potentially earn more through the transaction fees or like the incentives that I talked about earlier. So that's basically it, guys. If you enjoyed this video, leave a like and subscribe. Thanks for watching.